Good morning, Marc Ostwald from ADMISI. Wanting to share a few thoughts on where we are now in terms of financial markets after the event risk of the US midterm elections and indeed last night's FOMC statement is past us, and as we start to look towards the year end. We're in a complex situation because we're really now wondering what happens next. In terms of the US midterm elections, the big questions are obviously, how does Mr. Trump work or not work with the Democrats? It seems his strategy is fairly obvious now, that he is reaching out, or pretending to reach out, I should say, and ask for the Democrats to work with him above all on infrastructure spending, which is much needed, and both Republicans and Democrats know that it's much needed. The only problem is that with President Trump in the White House, the question is who gets the credit for it, and that's probably where the Democrats will already be in 2020 election mode. But where are we in terms of financial market flows? Let's start off with having a quick look at the VIX Index. I think it's really quite remarkable that immediately post the election, the VIX Index tailed off quite sharply. I think it tells us just how much was pinned in the way of speculation to the midterm elections, and that now with the midterm elections passed, perhaps we're not going to be in quite as an elevated volatility environment as we have been over the past month or so. However, there are other considerations at hand as well. If we move to the next slide, a slide which I present very, very often, but one always worth looking at again. It's a reminder that the S&P 500 at the moment is very, very heavily correlated with the US high yield average bond spread, or inversely correlated with the actual spread, very heavily correlated with the performance of the ETF. And the spreads are tightening, and that I think is instructive insofar as there were a few people yesterday who were a little bit disappointed that that the Fed didn't mention the recent volatility. Well, here's the thing: if those spreads tighten, if volatility drifts off, if the S&P 500 goes on another march higher, then the Fed is definitely going to be concerned again with bubble-like conditions in financial markets, just as it wasn't particularly concerned when we had the sell-off in the S&P 500 and US equity markets more broadly. And with the rise in volatility, it would rather see that rise in volatility, and that would give it scope, if needed, to perhaps pause. But for the time being, as long as we've got this rush for risk, so to speak, then the Fed will continue to signal, as it did yesterday, that the gradual path of rate increases, probably to a point which is well beyond the long-term neutral rate around 2 3/4, closer to somewhere like 3.25%, very much obviously contingent on what happens with the economy, is where they want to head. If we move on to the next chart, I think that's an ample way of highlighting via the US Financial Conditions Index, as much as financial conditions have tightened. When one looks at the left-hand side of the chart, which is where financial conditions were when the Fed first started hiking rates, we can see that we're still well below and trending back down again. This is basically another thing which keeps the Fed there. However, we are in a slightly different environment, and this is where the next two charts are actually quite important. The first one is the chart of central bank liquidity flow. I think what it emphasizes is we are going into an environment where central banks, the major central banks around the world, are starting to withdraw liquidity, and that is certainly something which is going to keep markets more volatile. However, I would stress again that as much as we may be impressed that 2-year yields are almost at 3% in the US, and that long-term yields have risen quite sharply, they're still not at a level where one can comfortably park money in those and expect investors in one's funds to say that's a good rate of return. They simply aren't good enough at the moment. And this is really where the next point comes for the US equity market above all. And that's and both in terms of the overall growth outlook and indeed in terms of market liquidity. This year, we may have seen central banks stepping away from the table, as that last chart showed, but we've also, as the next chart shows, seen a huge boost from corporate buybacks, or what I would call corporate QE. The question here is are we going to be in a situation where this gradually tails off? For into the end of the year, obviously we're into buyback season now that we've got the earnings season behind us. But what happens next year and in 2020? Has the corporate tax cut actually borrowed the boost that you get from buybacks from 2019 and 2020? Has indeed the corporate tax cut borrowed from growth in 2019 and 2020, particularly as there aren't going to be now with a divided Congress, with the Democrats in charge of the House and the Senate under the control of the GOP, we aren't going to see any real major stimulus measures. So then it becomes a question of how much does the US economy slow? And I would want to stress here, I'm talking about the US economy slowing, perhaps to as low as 1.5%, 2%, the thing that we've been largely used to. But where does that leave the equity market, given there's not going to be as much corporate QE next year? There's certainly going to be a negative flow in terms of central banks. And obviously there is the opportunity in it for funds which want to be more defensive to park money at the short end of the US Treasury curve and see how things develop, both economically. The final point relates obviously to how does Mr. Trump also deal with the US-China trade tensions? And that's actually going to be a critical point here, because if we get to a point where the US economy is slowing, then what would be good for the global economy is to see those trade tensions start to lessen, and then we could be slightly more optimistic about the global growth outlook. If, on the other hand, he becomes more combative, then obviously we will become more and more concerned about the outlook for the global economy.